Hi everybody, welcome back to Dividend Stockpile. Today's video we're going to be reviewing a very popular income ETF, QDVO, the Amplify CWP Growth and Income ETF. Now I did a video on this which is popping up on the screen right now when it first launched late last year. Now that it's been in business for 6 months, I wanted to take a second look to see how it's been performing and what's changed or what hasn't changed since it's launched. So let's get started. As you can see, we're on the Amplify ETF's website, and they're the ones that oversee this particular fund. So let's go through their product sheet to see what QDVO is all about, and then we'll start talking about the performance, the dividends, and the holdings that they have right now. All right, so first off, why invest in QDVO? So it says there's three main reasons: growth and high income potential. So this is an income ETF. They do write call options, and so it's for people who are looking for a higher income. They have equity exposure with lower volatility. Because it's an options writing ETF, the options writing premiums that are received help stabilize the volatility of the fund as opposed to just holding the underlyings. And it is actively managed. So the portfolio manager is Capital Wealth Planning, or CWP, and they are a well-known and multi-billion-dollar asset manager. Hopping over to the Capital Wealth Planning's website, you can see that it is founded and run by Kevin Simpson, and he's been in the asset management business for a very long time. CWP manages over $10 billion worth of assets and has been investing in blue chip stock portfolios since 2005. You can see some of the fund details. It was established in August of 2024, so it's just coming up on the 6-month period. It has about $25 to $26 million in assets, and it has about 58 positions right now, including the options positions. And the expense ratio is 0.55, which is very reasonable for an actively managed fund. Okay, so let's go into the objective and some of the other details. So the objective is to seek capital appreciation and secondarily high current income. They consist of large cap dividend growth stocks and is designed to provide high levels of total return on a risk-adjusted basis. Sounds good? So looking at some of the payout information, so you do see it as a monthly distribution. And based on the current distribution rate, it's paying a little over 8.5% per year, but paid out on a monthly basis. That's a very strong distribution rate. It's a good balance between the low income ETFs like VOO or QQQ, and it's not as high as some of the other high income ETFs that you see out there. So it's a nice balance. And with that balance, we're expecting to have a good total return. So we'll see. All right, scrolling down a little bit more, you can see some of their fund holdings. We're going to go into detail of each of these, but they're what you would expect for high quality blue chip names: Apple, Nvidia, Microsoft, Amazon, Netflix, Broadcom, you name it. So very popular funds. But what is really interesting about this particular fund is their methodology. So as you can see, there's 4 criteria that they use for their selections. First, they start with growth equities. Portfolio of large cap growth equities with historically strong earnings and cash flow characteristics. And then they break up their holdings by sector allocation. They don't allow too much in any one sector, which we'll go over a little bit in the future when we talk about their prospectus. Then they take from that pool of investments and they pick 20 to 40 stocks, which are screened and included based on attributes that they believe are attractive, including earnings growth, cash flow, relative performance, and the management track record. And then once they have that population of 20 to 40 stocks, they do a tactical cover call writing strategy. And what tactical means is they're not doing on the entire portfolio, and they're also not doing it on the index. They're picking individual companies to write calls on so that they can pick and choose which one is at the right time, as well as allowing for future potential capital appreciation. Because as you guys know, when you write a covered call, you're capping your upside in return for that current income. So we'll talk about the details and how much they're actually allocating to covered calls at this point. As I mentioned before, their sector allocation, you see, is quite diversified with information technology taking up about 41%, which makes sense because it's focused on the high growth companies, typically NASDAQ-related companies. So it makes sense that there's a large percentage in there, but it does have good diversification amongst the different sectors. And per their prospectus, they can go up to 50% in any one sector, but they can only go up to 15% in any one individual name. So that allows you to have pretty good diversification, even though you only have 20 to 40 names at any one time. Okay, here's where it gets really good: the performance. So if you didn't realize, QDVO has beat the QQQs, VOO, JEPQ, and their sister fund DIVO since they launched back in August. That's pretty impressive. We'll show the comparisons in just a second. But to have an income-related ETF outperform the QQQs and VOO, that's pretty impressive. I know it's only about 5.5 months, but that's a great start. Okay, let's dig into a little bit more of the details of what the fund does. We talked about the investment objectives. What I wanted to do is scroll down to how they pick their funds. So if you look over here on the left-hand side, equity securities portfolio, they pick large cap stocks from the Russell 1000 Growth Index, and then they identify 20 to 40 securities, and then they pick the individual weights. Again, this is actively managed. As I mentioned before, no one sector can be more than 50%, and each individual holding can be more than 15%. So this allows them to have a decent diversification based on the narrow focus of the 20 to 40 that they pick. And then in addition, as we talked about before, they do a covered call option strategy. And again, they write calls on the individual names, not the entire index. And their expectation for the distribution comes in two different places. The first one is approximately 0 to 2% from dividend income from the holdings, and then 4 to 6% from the option premium, plus, of course, the capital appreciation. So this is really important. They could write calls on the entire portfolio and get a much higher income from the options premium, but they're choosing to do a balanced approach, which allows them to give you both the income today, plus the potential for capital appreciation later. So let's talk about some of the holdings that they have as of right now. So this does update on a daily basis, so we're not going to always have the exact numbers, but it shows that the top holding is Apple, but it's only 8.66%. Then Nvidia, Microsoft, Amazon, all the high growth names that you would typically expect to see. They do have a few that you might not be aware of, things like Procter & Gamble, Home Depot, Amgen, United Health Group. Those don't typically scream out as growth names, but the managers of the fund felt that those were appropriate growth names to include in the portfolio at this time. Scrolling down to the bottom, I want to show you how the options work. So here are all the different options that they have in place. And as you can see, there's 1, 2, 3, 6, maybe 15 different options contracts right now. So instead of the 20 to 40 holdings that they have, they're only writing calls on a portion of them. And even of the stocks that they're writing calls on, they're not doing the entire position. So if you look at Microsoft, they currently have 12 contracts outstanding. So that's 1,200 shares of stock that they have overridden. And so if we scroll back up to Microsoft, you can see that they have 4,938. So they're only writing calls on 1,200, but they have 4,900 and some change. So that's what, maybe not even 0.25% of the position in Microsoft has a call on it. So the remaining shares have the ability to continue to have capital appreciation. Scrolling down again, you can see that, like Amazon, for instance, they have 16 contracts, and if you scroll back up to Amazon, they have over 7,000. So 1,600 out of 7,000 is being written via calls, and the rest are being left for capital appreciation. So that's where I'm talking about the balance between the current income and the growth potential. Another thing that they have done is they write call options on the entire index itself. So if you look down here, they currently have some on XND, and that's the mini NASDAQ 100. And so they actually have 125 contracts on the overall index itself. But this one's not a covered call. This is just a straight up call. As you can see, the XND call expires on 2/12/25, and with a call strike price of 206. If you look at the NASDAQ, the XND ticker is over 206 right now, so they're in the money on this particular option, which helps you with both the income we receive as well as the total capital appreciation. So overall, they're doing a really good job balancing that current income and the growth. They have high quality names that the portfolio manager screens individually to pick. It's not doing the whole index, and it's not doing calls on the index either. They're being very strategic. So let's look at a little bit more about the payouts. So as you see, they do a monthly payout, as we talked about in the beginning. It's only been 5 monthly payments. They just released their most recent distribution at the end of January, but as you see, it's been increasing every time, except for in December. They had a very large increase, and then it went back down to the normal range, but still a growing distribution and a growing total return is exactly what we should be looking for on this type of ETF. Okay, the next thing I wanted to chat about was how the distributions are taxed. A lot of people are worried about having a high income. They might get a negative tax situation compared to owning something like the QQQs. But if you look at the distributions for 2024, this column right here towards the right, you can see that they paid out about 75 cents per share over the entire time that it's been in existence, and 71.78 cents of that 74 cents was return of capital. And so 96% of the distribution is not taxable for us today. It's considered a return of capital. And I know a lot of people are a little worried about return of capital. You're just getting your own money back. But when it comes to options-based ETFs, that's not the case. They can use tax loss harvesting and some other tax strategies in order to roll forward any losses. So those losses can offset the gains in the future, which negates the tax burden. Now, return of capital does go against your cost basis. So after a long time, if they continue to do return of capital, eventually your cost basis will become zero. And then if it goes below zero, then you'll have to start paying taxes on those distributions, even if it is return of capital. But if you think about it, 75 cents a year, and if you take that by the share price, that's going to take quite a long time for your cost basis to go down to zero. So overall, I think it's a really good program. You have the high monthly income, you have a great total return, and you have tax efficiency based on the ETF structure that they have. So let's talk about total returns. So as I mentioned at the beginning, it's beaten all of these ETFs. So QQQ, they have beat by almost 2 percentage points in total return. Since the inception, QDVO is at 13.7, and QQQ during the same time is 11.86% return. If you look at VOO, again, VOO only has 9.78% total return. QDVO is 13.7. And if you go to QDVO compared to JEPQ, which is another a NASDAQ-based income ETF, you can see that it's even beating JEPQ. So 13.7 for QDVO and 13.67 for JEPQ. So close, but it's still technically beating them. And lastly, I wanted to talk about how it's performing compared to a sister fund, DIVO, which is one of my favorite. But as you can see, since the inception of QDVO, it has performed much better. So at 13.7 for QDVO and only 8.92% total return for DVO. And that makes sense because QDVO is going to be investing in the more high growth names, whereas DVO is more of your stable blue chip dividend stocks. All right, so there you go. Hopefully you enjoyed that summary and update on QDVO, the Amplify CWP Growth and Income ETF. It's a great fund, it has great performance, and provides a great income. Total package, if you ask me. So with that, put in the comments below if you have QDVO in your portfolio, or if you're interested in adding it in the future. I'd love to hear from you. And while you're here, make sure you check out this next video. It really does help the channel. And remember, keep stockpiling those dividends.